Welcome to the Dividend Talk podcast, episode 145, first quarter earnings in 2023. Hey everyone, welcome to the Dividend Talk podcast, a show that empowers ordinary investors to achieve financial freedom through dividend growth investing. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. I'm your co-host, Engineer My Freedom, and today I am joined by European DGI. Hey, European DGI, how are you, buddy?
I'm really happy because last week we were discussing about Johnson & Johnson and their dividend hike. And what did you say again?
If I remember correctly, I said roughly around a 5.6% dividend increase.
You must have been right, because that's like spot on. I mean, the big king, continues to deliver 5.3% dividend hike to $1.19 per share per quarter. 61 years of dividend hikes right now. But my friend, you believed that they would hike much less, right? Because you thought they will spend the consumer business and da-da-da-da.
Yeah, I did. I honestly thought they'd be a little bit more conservative and raised it to like 115, 116. So it was always on the low side. But look, I doubted the king, and the king put me in my place. And
what do we do for the king?
As such, I have to honor my bets, and that is to drink vodka live here on air. Just so the viewers know, it is a brand owned by Diageo called Smirnoff. I'm showing EDGI the bottle there to prove that it actually is vodka. Of course, it has to be Diageo. So for all you shareholders out there, I'm going to try drink this and keep it down.
Now, and this is, of course, guys, the only vodcast, and I will be loyal to you. So I'm going to drink some Żubrówka Biała, real Polish vodka. So cheers, my friend, on your loss.
Cheers.
But we're in it together.
I have to say, this is a lot harder to drink than that lovely Polish vodka that you brought over with you.
Yeah. Well, I think I'm starting to feel warm now, so I think we can get started with this show.
Yeah,
it's a podcast show.
It's a good place to start with dividend hikes, isn't it?
I think you need to drink on it. I mean, what else in life is there better to celebrate than a nice dividend hike from the king of the kings?
Yeah, 61 years now. We also had a couple of others who have hiked their dividends this week. Costco.
Mm-hmm.
They've hiked it by a whopping 13.3%. I'm not surprised. I've seen some people put up pictures of Costco in the United States, and it looks like there's queues absolutely everywhere. So I'm actually going over to America next weekend, which I'm quite excited about. So I might get to visit all these places.
Nice. And I think another dividend hike came from one of the companies you're also following, right? But I don't know if you own a position already.
I have a small position in Sonoco. Sonoco products, they hiked it by 4.1%, which gives them an impressive 41 consecutive years as well, which is quite impressive.
Yeah. And in this case, the ticker symbol is SON. From Nico in the end, right? We don't talk so much about the stock, so it's probably good to mention the ticker as well for our listeners.
Yeah. And we also have Blackstone there, who decreased its dividend, but I'll talk a little bit more about that when I get to that.
But that's very interesting, because you have been discussing Blackstone several times here, I believe, as an opportunity.
Yeah, but I think you have to be aware of Blackstone as well in terms of their distributed earnings, and that's what you need to look at. So I don't think a decrease is altogether unexpected. The overall trend, it's like a European company, they will drop it slowly, but the overall trend will be up. But if you're buying these as a pure play dividend growth company, it's not 100%.
Get that.
So.
I get you. Well, I only own G&G, right? So
Yeah.
for me, it's a nice hike again. I was happy that I could buy some on the dip the other day in the low 150s, so 3% yield. So this gives me a little bit more yield again, 3.15 or something like that on that buy, and not
Okay.
bad for such a king. But I will discuss soon a little bit more about their earnings.
Yeah, but maybe it's a good place to start now. Johnson
Yeah.
and Johnson. Now.
Okay, let's do it then. So, I just love dividend investing, right? So to see the king hiking 5.3%, I don't know, that is for me, I mean, it puts a smile on my face. My wife is not even able to do this so often. So it's an addiction. I realize that. Um, what I really am amazed by is that on a sales in one quarter of 24 billion, yeah, or almost 25 billion, they were still able to increase it by 5.6%. So we're really talking about big numbers here for pharma company, effectively.
Yeah.
Um, they do have, if you look at the bottom line numbers, and people don't get confused with that, you might see that they have a three cents earnings per share negative, but this has all to do with a 6.9 billion charge of the talc litigation settlement. But if you take that out of the equation, and you look at their adjusted earnings per share, then you're talking here about $2.68, and that's kind of flat compared to last year. And of course, the company is also hit a bit about inflation. But what is funny, so far, if you look at it, consumer health business that they're spinning off was flat for many, many years. And now they are like 7.4% up compared to last year, which is really nice. But I think it has all to do with inflation. Yeah,
Yeah.
these
Of
guys can
course.
now just charge more to all of this stuff. So that's really nice. But honestly, it stays the lowest and the smallest business, because although it contributes almost 4 billion to the 25 billion in sales, its profitability and the margins are just much lower than, for instance, the ones for pharma. So pharma, on the other hand, did 13.4 billion, and the medtech, so also the competitor of Medtronics, did 7.5 billion. And if you look at it, then pharmaceuticals was still able to grow with 4%, but medtech 7%. And here's where I'm really, really curious, because it makes me wonder what Medtronics will do. Yeah, because Medtronics has been struggling, and I'm wondering, is Johnson Johnson here eating their lunch, or
Mm.
can we finally also see some growth, proper growth in Medtronics? And now with a company like I said Johnson Johnson, I really look also at their pharma drugs and pharma, their, let's say, their top sales. Stellara is their biggest drug with 2.4 billion. It was growing by 6.8% year over year worldwide. And their second biggest drug, Darzalex, is now making sales of 2.2 billion, which is really, really tracing Stellara just by a little bit, but there was a growth of 22%. So I bet that Darzalex will be soon their biggest selling drug. And if you look at these numbers, right, it's like almost a 400 million more in sales. Darzalex is really pulling this company forward. Yeah. Also, Stellara is still nicely growing. We're still talking about under 50 million more. But when you really think about it, so consumer health, for instance, it grew by 250 million in sales, but then Darzalex itself already 400 million in sales. Yeah, so that shows just the difference, that one single drug increases the sales more than the entire consumer business can do with all its brands. So that's also where your risk is in this company, as I always say. But then also, if you look at the margins as such, they are just much higher in pharma. So all in all, I think decent numbers for this company, Johnson Johnson. Nothing to worry about, in my opinion. I think I would have loved to seen the adjusted earnings that they report growing a little bit better, but it is like it is. Now, to really I said, put an end to my Johnson & Johnson earnings review. What I found really funny is in one of their slides is that about their capital allocation strategy. So their capital allocation starts with organic growth for the business needs. That should result in free cash flow. Their free cash flow will be split in investment in mergers and acquisitions and in paying competitive dividends. And competitive dividends, it's so funny because we saw it with AT&T, we saw it with Intel. The moment they start using the term competitive dividends, we saw a dividend cut afterwards. Now, I see no reason this to be the case for Johnson & Johnson, but it was just funny to read the language here. They didn't say a progressive dividend or a growing dividend. They said competitive dividend. So really funny to read this. And I hope it's not like kind of already a subtle message to us, but I don't think so.
It's interesting language to use, certainly considering the two examples you gave, AT&T and Intel. You would imagine after increasing it by 5.6% right off the bat that it's pretty safe, but you'd wonder when the spin-off happens, are they looking at adjusting it and using something similar to what AT&T tried to do, not call it a dividend cut, but adjusting it down? I don't know. It's hard to know. But there is no doubt, look, good results all around. It's one of the reasons actually why it's probably a shame they're getting rid of the consumer health part, okay? Because we've gone through pretty much 0% interest bull markets when that was pretty much flat. But it's in times like these when this segment really probably excels, and it's now that they're selling it, which is quite ironic.
Yeah, but it's contributely hardly nothing. So
Free,
for me, it's I did once the analysis. It's like a 10 or 15% maximum contribution to the bottom line. So this is not something where for me it is just too small to be meaningful for this company in this regard.
So look,
Yeah.
you're happy. You're 3.9 billion. It is the smallest of the three, obviously, but it's
Yeah, it's 3.9 billion in sales, but it's just 0.9 billion in income. Yeah, while for instance, I said pharma makes 5.8 billion in income, and the medtech makes 2 billion in income. So sales looks nicer, and you would think like, oh, 11% growth on this. But if you then go to net income, the margins are just much lower. They have a 22% margin or something like that. So it's just not meaningful in that case, also due to its size. Then medtech makes a much bigger impact because it's double the size of the consumer health business.
Cool. So you're happy all around, and you're confident.
I'm happy all around, and for me, Johnson & Johnson is always, it feels a little bit like, but then if I look at it, I bought it first at $100, then at $115, then at, I don't know, 135, now at 152. And it just keeps on chugging along, and my yield on cost is nicely growing, and my position is growing, the share price is nicely growing. It's like a perfect example of compounding. So yeah, and if it continues to do like this, I'm generally happy with this. Yeah.
Nice. Okay, I'll move on to maybe give some European flavor to our earnings. I don't think there was too many Europeans that gave earnings, but ASML had their earnings this week, and it was probably better than expected. I think they've overcome the supply chain issues that they've had, which was one of the key components. We do know they had a large back order of their systems, but they've been able to deliver them a little bit more, I would say, more on time or earlier than they expected, which bumped up their sales. And their net sales was 6.7 billion, which is up from 5.3 billion last year. And their earnings was 4.96, which is also a pretty big increase. So overall, I think they're quite happy. What I was really interested in reading is on their first slide, they have investor key messages, and you're still a shareholder in Intel, right?
Yeah.
And the first two lines that they have is they'll talk about the global megatrends, but they are saying that they're expecting to see growth across the semiconductor market, which is going to increase their demand for their units. So I know semiconductors going through a bit of a rough patch at the moment, but these guys are preparing for substantial growth in that market. And I think that's probably a key message to take out, or a key component to take out of their earnings, particularly if you own the likes of Intel or any other
Yeah.
semiconductors.
I'm not surprised because if you see the boom of AI at the moment with ChatGPT and everything, this requires a lot of computing power. So
Yeah. So yeah, it's quite interesting. That really stood out for me. But overall, it was quite as expected. We knew that their sales was going to increase. It's actually nearly, not quite, but nearly double from this time last year. Their net income has gone up in tandem with that. Their bookings has halved, but we know that backlog created that as well. So all in all, it's quite good. On top of that, remember that they have always almost doubled their dividend as well. I think it was 275 in 2020. It was 550 in 2021, and now it's going to be just above that, maybe 560, 570, I think. So it's a smaller increase, but based on 2021 to 2020, it's still a huge dividend increase. And they're still buying back shares to boot as well. So overall, I think it's a strong return from ASML, but I think it was predicted. They teed us up for this over the last couple of quarters, and now we're starting to see the fruits of it. So it's good to actually see them deliver on what they are saying. And also they shipped a couple of their new systems as well, the NXT 1980 FI as well. So they're starting to ship some new equipment, which is good to see.
nice one. Yeah, I mean, the company just keeps on rocking, right? In generally, I know it cooled down a bit again in share price with all the China worries, and I believe TMC is also ordering less. I believe
Yeah.
here. So this whole geopolitics and the export controls is of course just like called a semiconductors war. But when you're a full monopolist, and yeah.
I mean, yeah, there's not a whole lot more they can do. They're actually predicting 25% sales growth in 2023, and they're off to a pretty strong start with that. So,
and I actually read this week that IBM, I don't know, invented a 2 nanometer chip or something like that. I haven't gone down into it and did an analysis on it, but it was quite funny to read because probably I don't know the details, right? But just speculating here a bit, probably IBM is just having, like I said, a patent, but isn't able to turn it into earnings or something like that. But it was just funny to read.
Yeah, I just did a quick Google on that while you're talking, and there's an article dating back as far as the 6th of May 2021. So nearly 2 years ago from IBM research that they're doing that. So who knows? Who knows?
Yeah.
I'm not confident that IBM are going to be able to do that.
No. Well, then maybe speaking of which, I actually looked into IBM again, and you might wonder why. I just love it as a stock to follow it because there's so much wrong with this stock that I also feel like it's maybe still interesting for our listeners. Tell me if it's not, but I believe it is. I mean, my opinion about the CEO. The lady is out. The guy came in. He is as boring as hell. They keep on talking all this gibberish. But okay, let's look just at the facts. Revenue, 14.3 billion, up 0.4% or 4.4% at constant currency in an inflationary environment. So they're not able to pass on the inflation, I would say, as such to the customer. But if you then look at the different business units, what is interesting is the software revenue is up 3%, consulting revenue up 3%, and infrastructure revenue down 4%. Of course, there are large currency impacts in all these American companies due to the dollar, right, here. So otherwise, we're talking about it being up 6 or 8%, so also fair to them. What's good to know is that their free cash flow is about 1.3 billion, up 100 million since last year. But what really caught my attention is that Red Hat is up 8% or 11% in the current constant currency. And it continues to really pull everything up, because if you look at the other software revenues in this 5.9 billion, it's all flat. effectively. It's just a flat business, I would say. And that's really interesting. But we saw double-digit numbers in the past from Red Hat, and that's not what I'm seeing now anymore since last time I watched. And that's also, but I'm not surprised because many of the corporates are scaling down. Think about all the employees that they are releasing in the tech industry. So as such, I'm not really surprised that a company of as IBM feels a little bit of headwinds in this. Consulting, which is like making up 5 billion out of the revenue, and by the way, software was about 6 billion. So consulting is really big. In general, it did actually quite well because it's their best performing unit at the moment. It grew 2.8%, but then 8.2% in constant currency, which is really nice. And then infrastructure services is having a revenue of 3 billion. And yeah, not a lot to mention there, I would say. Now, what for me is interesting, of course, and this is where this company always shines, is their GAAP earnings are $1.02, and their non-GAAP earnings are $1.36. Most of the 36 cents are being attributed to the, how is it, the, how you call it, the spin-off costs and everything, integration costs. And I wonder really when these guys start to put it just in the GAAP earnings, because it is already for 5 to 10 years continuously the same, but it creates a 30% gap. Yeah. And I will put the plug in the numbers in my graphs again, where you just see that over time they are lying to us effectively on 30 to 40% continuously every year in and out on the difference between GAAP and non-GAAP. Yeah, and that is just really painting the grass greener than it is. And if you think about it from that point of view, the first quarter of the year is always a little bit difficult for them. From that point of view, they have 1.3 billion in free cash flow. They expect 10.5 billion over the entire year. So we're talking here about 10%, let's say, of the 12% of their free cash flow in a single quarter. But the dividends were 1.5 billion. So just this quarter, they were underwater when you think about the free cash flow. And a little other thing that I don't like about IBM, because I don't like them, they were diluting shares again by 1% here, where you usually see the opposite in companies because of some buybacks. But we know that they have a lot of stock plans for management and such. IBM is really a company that is not there to enrich the shareholders. The share price went nowhere over the last decade almost. The earnings went down over the last decade, and the only ones that went up were the salaries of management. Clearly, management and shareholders are not aligned here. And honestly, I don't understand anyone that is still holding IBM after this decade. I really don't understand it. I still see people on social media appraising IBM. I just don't understand it. It's not a shareholder-friendly company. They do all the buybacks and everything in the past. They just leverage themselves up to the tits. I really, really don't understand it. No shareholder value created in the last decade. Amazing.
Yeah, I think it's the 5% dividend yield that might be doing it for some investors.
Yeah, true. And you could consider that shareholder value to some extent. But yeah, nothing meaningful for the rest. Dividend is usually something that you get after the company is growing its earnings.
Yeah, it would depend on when you bought them. I mean, if you bought them 5 years ago, you're probably losing money in share price. If you bought them during COVID, you've made it a little bit of money, maybe 25%.
Yeah, but then you're looking at it from a value investor.
Yeah, of course.
Yeah.
Like it's all relative. It all depends on your circumstance. But I mean, I've lost faith in this company a long time ago. You ask if it's interesting to listeners, it probably is. But for me, I've lost complete and utter interest in this company and faith. So I don't tend to follow them. I don't believe a word that they say. And as you said, like GAAP to non-GAAP every single year. How can you have a consistent one-off charge every year? It just doesn't make sense. So
and then it's just management. It's just simple operations, right?
Yeah.
But for me, I follow this company just because, I learn equally as much from companies like this as I learn from the good ones, because these are the companies that remind me like what to look for, what you don't want to see in the companies that you own.
Yeah. Yeah, true. Well, good. I hope you got that all off your chest. It was it was good to listen.
I kept it peacefully, right? I didn't
I,
make any insult to the CEO
I
today.
I was just going to say it was very very peaceful. I was expecting
Yeah,
worse.
that's what vodka does. Should we
Good
do
stuff.
another shot?
Oh, great. Okay, let's do it.
Yeah, let's do one. I mean, in the end, it's the vodcast.
And you know
Taste
that
your dividends. And the guys that are listening to this podcast that are running now, I hope you don't get thirsty from this. But we're just doing it for you.
to Diageo.
Good. To the Diageo dividend hikes whenever they come. Your face.
Oh, it's so hard to drink. Okay,
Hey, tell me more about Blackstone now.
Blackstone. Yeah, so look, we've heard a lot about Blackstone lately. They've been in the news for negative reasons pretty much nearly every week in 2023. We know their real estate business has come under huge pressure, even so much that they are not allowing investors withdraw all their money. So look, it's no surprise that they've cut the dividend by 10%. It is based on their earnings, which have all been down. So if we look at the total revenues from a start, the total revenues is down nearly 4 billion over the same period last year. A lot of that to do is with their investment income. The markets, look, they're trying to adjust to these new markets like we all are, with increases in inflation, increases in interest rates. So we can understand to a certain extent that their income from investments is going to be down, and you can see that's quite heavily affected based on that. From that, then you look at their net income, and their net income has been down quite a bit as well. So it went from nearly 2.5 billion this time last year to 210 million this year. So they took quite a significant drop. What people look at mainly with Blackstone is obviously their fee-related earnings, so how much money they are making from all the fees that they are from investors and performance related and compensation and so on. And that was down 9%, which is not so bad, but their dividend is not paid from that. Their dividend is paid from their distributable earnings, which was down a whopping 36%. So when you look at that, actually a 10% dividend cut is not too bad in the midst of things. Their total assets under management actually increased in this area. The one thing I will say is that Blackstone, in these moments, you are going to have peaks and troughs, and we're going through a little bit of a trough at the moment, particularly what's going on in the markets. But what kind of kept investors happy, even myself happy, is they have this figure they call dry powder. So it's their war chest, and they have a lot of my bonuses in there, I would say. So their war chest is sitting comfortably at about $200 billion. That's a lot of money.
Hallelujah.
A lot of money. And I know they are not just sitting on that. So they are looking at opportunities. So for example, in the real estate world, they're looking at this investment trust in the UK called Industrial Real Estate. And they own offices and warehouses all throughout Europe. It's actually pretty good UK privately owned real estate. So they are now looking to buy that out because that's a private company held in an investment trust, and it's trading at a massive, massive discount. They are now sweeping that up at a massive discount. And then when we do see a recovery, we'll start to see gains from that. So they are making a lot of deals like that behind closed doors. Some of them are not so secret. Some of them are a little bit more secret, but they do have a lot of cash. These are the times where they make the money. So they're looking for bargains. They're going to invest in it. And if you are an investor in Blackstone, I would pay attention to that, and particularly if you're looking for dividend growth year on year, you're not going to get that in times like this, particularly with the distributed earnings shrinking. But I think 5 to 10 years, I think these will make a decent pay. And just to reiterate, their dividend policy is that they always look to pay 85% of that distributed earnings. So I think as an investor, you need to pay attention to that what it's at, what the markets are doing, because remember, these are asset management companies. They're heavily involved in private equities, real estate, and general stock market as well. So it's going to be affected by all those
Yeah.
things. So overall, I wasn't too disappointed with it. I think this stock price held itself steady because of the dry powder that they own, the deals that they're making. There is still a lot of negativity. In terms of price, I was buying these at around 80, 75, 80. I still think that's more than fair value. I don't think I'd be buying them at the moment. They have recovered quite a bit in share price. They're trading at around 90, I think $90 at the moment. I'll double check that.
Yeah. Which is like
Um,
a 2 years low,
yeah,
almost. Yeah.
it is, but they were trading at 70 when I
Yeah.
was recommending them trading at 70.
Yeah. Yeah.
I still think we're going to see a pullback on these, and I will not be buying them until they get back down around the 70 mark
Okay.
again.
But then you're saying also like you get like a 4.5%, 4% yield on this one. Yeah.
Yeah, it'll be 3.65%, I think, based on
Okay.
their new dividend. It's just still not too
Nice.
bad.
Nice. Good. Yeah. Yeah. For me, T Rowe price is for more from the dividend growth point of view than a bit more attractive. But I
100%.
can see what you like in Blackstone here. Yeah, definitely.
Yeah, it's definitely not a dividend growth company, a traditional dividend growth company.
Yeah.
T Rowe price is definitely the way to go
Yeah.
if you're looking at that. But there's a mix here. There's going to be some capital appreciation and that. I could be wrong, but I'm banking that they're going to make their money over the next 2 or 3
Yeah.
years, and in 5 to 6 years, I'll start to see the benefit of that. That's
Well, you're just justifying why we are called dividend talk and not dividend growth talk.
yeah. Well, there's all different streams of it, isn't there? There's dividend growth. There's high income. There's all different
Exactly,
streams.
exactly.
We
And
have to.
we should have one time a guest on our show that really is focused on high dividend yield. Yeah, like the 8%, 10% yielders. I would love to hear this view one time.
Yeah, it would be. There should be Dividend Bull on YouTube. He would be one actually to have
Okay,
on.
let's try to see if we can get them.
Yeah.
And then you looked at our favorite Snap-on ticker symbol SNA company.
Strap on, yeah, snap on. They popped up quite significantly in share price, didn't they? They had a strong quarter, which I'm really surprised at. We think of inflation, we think of.
Yeah.
I genuinely thought like these are premium tools that they sell.
Mhm.
I used to work as an electrician, and I'm thinking if tools go up by 11, 12, 13, even 20%, and you have the same one from a cheaper brand, I would probably go to a cheaper brand. But these guys seem to have such brand power. Their net sales actually increased by 7.8%, and that's after a negative currency impact
Mhm.
of 2.4%. So their actually organic sales was up 10%. And you can see that the whole way through. Their operating profit, their adjusted earnings was up 15% as well. So it's quite a strong year. But if you look at all their segments, it performed pretty well. The commercial and industrial group, 11.1% increase. Snap-on Tools Group, 6.3%. The repair systems is up 13.9%, and the financial services was up 22.5%. I have to say I was quite surprised by this. They've got plenty of room to grow their dividend as well, their free cash flow. I think dividend to free cash flow is sitting about 40-50% in around that range. So it was a strong quarter. It was unexpected, I have to say. I didn't follow Stanley Black and Decker, but I wonder if they're going to have a similar quarter to these guys.
Yeah, yeah. I mean, Snap-on is super high quality, pristine balance sheet, very low dividend payout. Of course, the yield should be a bit better for me, but it has everything. I missed the boat on this one a little bit at a certain moment. Yeah,
We missed the boat because when it was said to us, we made fun of it. And I think
yeah,
when it was said to us, it was trading at maybe 12-month low.
yeah,
And I honestly thought it might come back down in this period
yeah.
to a more respectable level. Well, it's still trading at an okay level, but I still.
I think from an earnings point of view, it's trading nicely.
Yeah.
But from a dividend yield point of view, because the payout ratio is so low, that's where we're struggling.
Yeah. 2.46. See, for me in this market, it's hard for me to invest in something with 2.46% when you
Yeah.
can get something for 4 and 5% with a similar quality.
Yeah.
That's
Yeah.
my struggle.
Exactly. Good, good, good. So, hey, these were five stocks that were reporting the earnings this week. It's just a start. So, I hope we will get much more over the upcoming 1-2 weeks. Of course, I'm always looking at my top five positions like Royal Dutch Shell, Ahold, Unilever, ExxonMobil, AbbVie, Microsoft. So, it's actually more than five. But yeah, I'm really looking forward for all these earnings coming in.
Yeah, it's
And I'm
going to.
actually really curious what OpenAI and what the narrative will be about this in the Microsoft earnings and what Microsoft has been able to do with Azure, because they are locking this in via Azure. And I'm really wondering if we are seeing, I said, the first signs of that this is still, even, I said, putting more to the curve and to the exponential growth curve into the Azure sales.
So I must ask you, are you still using Microsoft Bing?
Yeah.
Yeah.
Actually, now our Google Meet is going via Microsoft Bing.
Good, good. I'm still using it as well. I think I would say I use it 90% of the time. There is the odd
Yeah.
occasion where I need to actually go over to Google to get what I want, but still,
Yeah.
it's still a decent job.
I think so. Yeah, I'm quite surprised about the quality. Hey, good. So we have several people that reach out to us for their portfolio reviews, and guys, have patience with us. There are like 3-4 in the queue. Your turn will be, but today is the turn of Tim, one of our active members on the Facebook group here, and he has shared his portfolio with us. A little bit background, maybe. He started picking his dividend stocks since January 2022. And I said, actually, he lives in Denmark and he's trying to reach financial independence in 19 years from now. Generally, because he's from Denmark, of course, he prefers Nordic stocks like from Denmark and Sweden. What I'm really proud on for him is that he's able to dollar cost average 30% of his income into index funds every month, 30%. So he's already at that stage, and that's already wealth generation. So really kudos to him that you're able to do this already. However, he wants to turn his dollar cost averaging into ETFs slowly into companies while he's learning about stock investing. He wants to buy companies that he feels comfortable holding for at least 20 years. He had also lump sum in cash, and he divided that in 20 parts, and he bought already 70 companies. And he also wants to own just 20 companies in total, just because of the lack of time of studying more, because he wants to only look 2 times a year at their reports to see how they are doing. I mean, textbook material here, what I'm reading, really, really awesome, this process already. What I found really funny is that last year he covered 1% of his annual expenses because he just started. But this year his goal is to cover his lunches at work with dividends. And this is what I love, because I do this as well. For instance, my Shell investment pays for my oil and gas, for the car mostly. And I often think like that. I often think like, okay, I'm paying every month my internet bill and my phone bill. Maybe I should own some shares in such a company, so that when they hike the let's say the phone bills, I see the dividend hikes coming in, right? So and then you have your investment portfolio like kind of mirroring your cost. I said what you spend your money on.
Yeah.
So that's really a nice way of looking at it. Now, he's asking us a little bit to, of course, review his portfolio, but also have a look at the sector distribution and how he would like to allocate his money. Now, first of all, what's good to know, and this straight away also my feedback to you, Tim, 24% of his dollar cost averaging in the ETFs went into the Van Eck Gold Miners UCITS ETF. This is really funny because we're a dividend talk. It's a gold miners ETF. And I wonder, Justin, why? Was this already something you were doing years before? And then if so, what are you going to do with this? Are you considering holding this? Because it's really a lot of money. and gold miners, it sounds really, really interesting to me that you're investing or that you have been investing into that. So there's no clarity on why you have so much. I assume that this is still like an heritage from your pre-dividend investment, dividend investing time. But if you then go to the stocks, his largest position is Texas Instruments, 7.2%. And he has a target allocation of 4%. We know how it goes when you're in accumulation phase, you're just building up the positions, right? Uh, Kudos to that, is my opinion here. I believe his second position is Stanley Black & Decker. We just heard about Snap-on. Stanley Black & Decker, I think it's a yield play for him because it pays him currently a 4.7% yield approximately. And then his third position is Castellum. And here I was just wondering, like, Tim, why are you holding it still? Because it decided to postpone its dividend, to not pay a dividend at all. And I can imagine that you're still holding it from a value play point of view here, because there's still a lot of value in their assets that they have in their properties. But the question to me is like, what are your rules for selling a company? And I think it would be good to spend some time on that. To just think about, when do you want to sell a company? Is it after a dividend cut? Is it after some fundamental change or something like that? Because you're also relatively new in the dividend investing strategy, because you started last year. Really, like, think about when you want to sell a company. This is something personal. Derek and I are not like that we sell companies straight away after dividend cut, but it is a really strong time to reevaluate. You also identified it in red, so I assume that you know there's stuff going on there and that you're maybe wondering what to do with it. Personally, I sold it and I reinvested half of it back, I believe almost half or maybe even more, into Cibus, because I wanted to retain the dividend income and I still was interested in Swedish real estate firm. Now, having said that, the next largest company for him is Hexpol. We actually discussed that one when we went through the Swedish stocks. So the ticker symbol is Google ticker symbol is STO and then HPOL-B. It is, I believe, 5% of his position, and I don't have a lot to mention there. I believe we found the company quite interesting and such. Polymer, I believe,
PVC,
it's producing.
Yeah.
Yeah, so boring business, but seems to be solid, right? And then I think the company after that, if I'm correct, was Abbott Laboratories. And I think with Abbott, it's an excellent company to own. One of the lower yielders also here, but I think you will really do well with that one. So generally, I think you have some stuff there in your portfolio where I would say from the top 5, like, specifically Castellum, what there. But then if you look at the rest of the stocks, I really like that he has the Noble 30 index companies in there, like Assa Abloy, Novo Nordisk, Coloplast, but also Spirax Sarco Engineering, right? These are epic compounders on the European continent. So all I can say is that he has really high quality in his portfolio here from a European continent. Yeah, that's from my side.
So what I will do is I will defend him a little bit. I think you missed one sentence in his piece where he says, P.S. forgot to mention, if you could review my target portfolio or allocation.
Yes,
which is where
next step.
Which is where I hope to be in 12 months' time. Okay. And when you were talking about the ETF 24%, if you look in 12 months' time, he wants that down to 6%. So I think he's acutely aware that it is overweight in his portfolio. Similar to Castellum, he has that at 5.72. He wants that at 0% in 12 months' time. Now, the question I think you asked him is valid. Why are you waiting? And I think he has mentioned if they keep the dividend. But that would be the big question here. Why are you waiting to sell that if in 12 months' time you hope to have that at 0%, which would probably be my comment. In terms of the portfolio, what I do like is he's outlined his strategy. And sometimes people have a strategy and they write a strategy, but the portfolio doesn't match the strategy. And sometimes I'm guilty of that. What I liked about his, I want to buy companies that I can hold for 20 years down the line. Okay. And if you look at the companies that he owns, Unilever, Nike, Diageo, Assa Abloy, Coloplast, Stanley Black and Decker, Carlsberg, T. Rowe Price, every single one of those, you would have no problem in holding 20 years. So I think
Yeah.
his portfolio matches his strategy quite well. The only thing I would say in terms of the ETFs, there's a lot of ETFs there, but they all seem to be in the same sector. They're all
Yeah.
global ETFs. Why do you need, or is it 1, 2, 3, 4, 5, 6, 7, 8 different ETFs in the same sector? Maybe you need to diversify that into different sectors. I don't know, but that would be my only comment on that. But in terms of the overall structure of the portfolio, I think it's quite good. I think the target allocations is also quite good. You're looking at mainly ETFs, which I think is, we've said before, I think it's the perfect strategy for most people, particularly new people. And if you only want to look at companies once or twice a year, ETFs is probably even better again.
Yeah.
It doesn't suit an Irish investor to a certain degree, but I think the strategy is quite strong. Looking at those companies, it's very defensive. It's a lot of consumer staples. There's a lot of real estate in there, but he has a nice scattering then of industrials and materials. So I think it's quite nicely laid out.
Yeah.
And I think the target percentage is quite good. But the question over Castellum, I think, from what you said, is quite valid. Why are you holding over them? You have a good strategy, but you need to define that a little bit more in and around what you're going to do with dividend cuts.
Yeah, and I would say, Tim, don't be shy, share this in the Facebook group. Just do it. I mean, I think you'll get really lots of good feedback that can help you. Of course, also ignore the feedback sometimes. Yeah, we do that as well, because you can't borrow conviction. By the way, plug, yeah, I've got the hoodie.
I'm
wearing it right now. You can't borrow conviction, and I love it. So I will wear it also on the street. Let's see if people actually respond to it, like asking me, like, what is this? But I must say the material is actually quite good. So I'm not saying this just because of our web shop that we launched, but I must say I like it myself as well.
I have mine on. I'm actually disappointed. Mine is actually due to come on Monday. I've checked.
Okay.
We ordered at the same time. It goes to Poland before it gets to Ireland, obviously. So
yeah, I ordered it in the weekend and I received it yesterday on the first day. And I have got also the T-shirt. Bankers are wankers. So
my son wants to buy that, and I have to buy it for him. So
yeah, I'm really. Someone said like I should go walk into my bank. It's Poland, so I don't know if they know English, but I should wear it one time when I just go check up on my account in the bank.
It'd be funny. Yeah, but look, back to Tim. I think as EDGI said, don't be shy to share this. I think it's a good strategy. I think it's a perfect strategy for most people, and I would like 90% of the companies you own. I don't know much about the ETFs, so I can't comment on them. But in terms of your stock portfolio, it's quite decent. Okay, listeners' questions. Tiago has a very good question. It's one that I would like to know myself, and that is, have you ever considered talking to an index provider about formalizing your European Aristocrat Index? You should do that.
I have thought about it. Yeah. But come on, guys. It's my job is working at my company, what I'm doing. That's my job. Yeah. This is my passion. And my approach to bankers and everything. So I don't want to spend a lot of time on that to make others rich with an ETF or something like that they will get all the benefits from. I'm pretty good with my trading 212 Pi. This is a job for me. The costs are really, really low. So it works for me. Let index providers do a little bit of work themselves, yeah, to come to this. Yeah. Why should I do the work for them and then they just creating then an index and make millions out of it?
Share the wealth. Yeah.
No. If there's an index provider that would say like, hey, from the 0. Well, first of all, I wouldn't allow a 0.6%. How is it? total fee or something like that. I would like to see that 0.3%. And then I would like 0.1% of that just for the intellectual property.
You can make yourself rich.
I don't know if it makes myself rich because that requires assets under management. But I think, like, come on, I don't buy for nothing a t-shirt, bankers are wankers. Yeah, I still need to find the first banker that does proper research. Yeah, so I'm not just like parroting the CEO and then giving like sell and buy recommendations that make no sense at all.
I get you. Cool. Lars has asked us one of his favorite, probably all of our favorite investors is Peter Lynch. He describes 6 different kind of companies: slow growers, stalwarts, fast growers, cyclicals, turnaround, and asset plays. In your portfolio, did you take a closer look at this kind of diversification besides dividend growth?
This is so funny. When I read the book, actually I did this. I started putting this behind every stock. Nowadays, I don't do it anymore. I just have dividend growth or turnaround. Yeah, but I have been doing this. I've been once categorizing everything in slow growers, stalwart, and fast growers, and it was really insightful because most of it for me ended up in slow growers and stalwarts. And that's also the reason why I at the time started thinking about something like Apple as an example. Yeah. So it did me well, and I think it's a really good way of looking at your portfolio, and I can everyone recommend one time to do it because you might see that you're, for instance, biased towards a certain type of company, and then the question is like, okay, why am I always investing in slow growers? What is it? Yeah, because maybe you're just buying also a lot of broken companies with this or and such, and I think the mix is so important. That's what my learning is. When I look at my portfolio, if you would look more like at total return, the mix is really what makes the difference. And you don't know what if the slow growers will now be the trend because, for instance, the stock market, there's a recession. Maybe then the slow growers hold up really well in a down market. But you need a mixture, I think, here. So I really love this question, Lars. Really good one. And I think I've done it. And I think everyone should at least use this lens once on their portfolio.
Yeah, I don't use those 6 different types, but I do use turnaround plays. I have different dividend growth, pure dividend growth, then high yield, and then ones that don't pay dividend as well. So I have done that exercise. I haven't done it that exactly like that, but I think you're right. It is good to understand, and you can see that actually with Tim. If you go up to Tim's portfolio, he does have it listed beside core cyclicals, bond like. So he's done a similar type of exercise to that as well. So I think it is quite important to understand what you own and the different sectors, the different types of companies that you own, and have a good mix. But yeah, I haven't done that exact one, but I think it might be a worthwhile exercise.
Yeah. And then Casper Kornak is asking whether we have any thoughts about the railroad earnings this quarter. So my response, first of all, I just hope that the earnings are on time.
Like railroads. To be fair, railroads are usually solid. I know 2, the Canadian one and the US Pacific one, and they're the 2 that I know. But generally, they're a monopoly. They are needed. They are something that's not going out of fashion, and their earnings and revenue and dividend goes normally up the way. I'm not too familiar with European ones, but honestly, I don't have them in my portfolio. I still struggle with paying a premium for them, so I don't tend to keep an eye on their earnings.
Yeah, and I don't follow this industry, so I cannot say anything meaningful, Casper.
Yeah. Andreas has asked us, GMRE, have you made any moves? So that is Global Medical REIT. That question is for me because I had a video about 3 REITs that I would like to own, and that was number 3 on my list. Much to the surprise of many people, I must admit. But what I like about this company, look, it's as it says, a Global Medical REIT. They buy buildings, hospitals, medical facilities, and rent them out to medical people. It's quite a simple business model. They have a really high dividend yield, so it's not a dividend growth play. It's more of a high yield play. They have a small bit of dividend growth, 1 to 2%. I think it's a good business model. They're getting really hammered at the minute. And that space in particular, REITs, but particularly medical REITs, is coming under a lot of pressure. But they are well covered. I think they are going to do pretty well over the next 3 to 4 years, and their dividend is pretty safe, and it's progressively growing all the time as well. So I did dabble. I bought a small few shares in them. I also have started trading 212 Pi, which I have Realty Income and a couple of other REITs in there as well. But I have also bought a position. I don't treat trading. It's weird. I don't treat trading 212 as investing. I set up pies and put 50 here, 50 here every week, and it's automatic. But it's so funny because it just grows without me knowing.
Yeah,
I don't
bounce nicely,
and I don't count it, and I probably should. But I have bought 100 shares of them outside of that as well.
Nice.
He's also asked a second question, which is, why are there only one stock from Poland?
Okay, for me it's really simple. Yeah, so I like, of course, Ambra.
Yeah.
Then you have LiveChat, which is, I think, astronomical. If you see the dividend growth and such and the earnings, but generally there are not so many good dividend growers. There's some that have a high yield. They are more like high yield plays, but I'm looking for pure dividend growth. So there are not too many there. And LiveChat for me, if you look at the payout ratios, is not interesting enough for me. Although if you look at the growth record, I think it's such a high growth company that if you're into more growth investing, you should look at it. But from dividend investing, my how is it? My analysis shows warning signs, because the dividend payout ratio is quite high. If I remember correctly, I might be wrong here, but it would mean that in that case, like if they have one time a setback in earnings, that straight away their dividends are at risk, and it's a relatively unproven company from that point of view. So that's why I'm not interested in it. But of course, I live in Poland. I would love to own more Polish companies, but for me, Ambra is the real one that I feel really comfortable with owning, and that's maybe the reason. Just not consistent dividend growth for most of the stocks.
Good. So we have a question there about a portfolio review, and I think you've addressed that earlier. We do have a few in the backlog. We will 100% get to them all. We don't have them every week in the show, but we are getting through them. So don't worry, we will 100% get to your portfolio review. I promise you that. Flo has asked us, what do you think about Alexandria Real Estate? Ticker symbol ARE. It's quite a bargain in his opinion, and it came back, and its future should look bright.
Well, fun fact is Brett Thomas is, of course, the iconic real estate investor writer on Seeking Alpha, and he's also really, really bullish on this stock. So ticker symbol ARE. Look, his case is like it's a pharma, right? Different kind of business. I fully understand what it means, because then you're talking about labs and everything, and if you're a pharma company, you can't just move out from this. You need specific buildings for this as well. For me personally, it is a new stock that I'm not really familiar with. Based on the screener criteria, it has 12 years of, if I remember, of dividend growth, a pretty decent yield. I don't have it in front of me. I'm doing this back of mind. Was it like 3.9% or something like that, dividend yield?
I think so, in around that.
Yeah. So it is also a relatively decent yield. It's trading, also at a low, I believe, 12-month low. So for me, let's say like that, from a REIT point of view, it passes my screening criteria. So it's just stock that I should probably look into. But honestly, I think, and there was a large discussion also on the Facebook group at the moment about Realty Income. I think Chuck asked a question. Was it Chuck or was it Billy Pritchett? One of the two, maybe Billy. They asked a question about this, and and I think Marek from Poland answered like, guys, 2-3 years ago, if realty income was trading at 5%, everyone would be all over the place. And now we're asking questions, and that was such a solid and good comment that it made me think like maybe I should dabble in it a little bit more on realty income rather, because I don't need another real estate investment trust at the moment in my portfolio.
Yeah, so when I seen the question, I've heard this company pop up in the last maybe month or so. Particularly, I think Dividend Seeker. Someone on Twitter is mentioning quite a bit, and I see him on YouTube all the time as well. When I see office REITs at the moment, I find it quite hard, particularly in and around when people are working from home and how that's going to look. And it's a tough space to be in. Brad Thomas, as you said, has called this, in his words, probably the safest office REIT out there. So maybe Carlsberg did that quote from, but that's what he said on it. I'm not too sure. It's not a space that I'm 100% comfortable in. REITs is not my strongest point. Then I only have a couple of them. I have Vici, I have GMRE, Global Medical Trust, and Realty Income. What I am actually doing as well is, that I have CEFs, closed end funds, and there's one fund out there called TR Property Investment Trust, and they invest in all different types of investment trusts throughout Europe. They're a European-based one. They also have some exposure to US ones as well, and that gives me enough exposure. And it's managed by somebody called Marcus Mudge, I think his name is. He's the manager of it, and I listen to his podcast. He's fairly knowledgeable. Talks about Vonovia, the German market, all these types of things. He's really good. But I'm more than happy to get a 6% yield on that of someone that knows all these markets a little bit better than me, and let him work his magic. So that's where I am. So I find it hard to invest in office REITs at the moment. I can invest in something like Vici because I think Vegas is not going anywhere. I can invest in Global Medical Trust because I also think the same with hospitals and all those clinics. And Realty Income is obviously Realty Income, but anything outside of that is a struggle. Cool. Next question is from Jay, and he asks us, if a company has cut the dividend historically but has started to grow the dividend after the cut, would you still consider buying them?
The academic answer is it depends. I think we always mention here on the podcast that we did this with Shell at the time, Royal Dutch Shell. So for me, it's more like I don't necessarily sell straight away after a cut. It's for me to reevaluate and what is the reason, and can I see it as a reset, and then based on the opportunity cost, do I think it's still a good investment? 9 out of 10 times, I would say the company is broken when they cut the dividend. So I guess it's mostly maybe with cyclicals where this could happen. Honestly, I would really consider 2 or 3 times even before investing in the company after cutting their dividends. It's so hard for me to do this. I think it's the value investor in me that would like to do it. But for me, it's kind of like, it shows rather like a lack of commitment to the dividend. So I'm leaning towards saying no, but it still depends on really what the context is and the situation is. And I think this is also what investing is about. I think rules are good. Rules are really good, and you should apply them in most of the times. But there's also something like about common sense and being a bit streetwise. And this makes investing also so interesting. But maybe I'm wrong here. Maybe having strict rules will outperform. I don't know. I don't know how to benchmark that, backtest that, but that's my thinking about this topic.
Yeah, the big question mark here is why? Why did they cut the dividend? And look, there's many reasons for that. But for example, if a company historically cuts it when they go through a bad period, and a bad period is coming up, maybe it's not a good time to buy them. Buy them afterwards. Someone like Blackstone, for example, where you expect them to the dividend to chop and change, but grow evidently over time.
Yeah.
There's always different scenarios, but I'm like you. Yeah, I would not rule it out completely. It just depends on the why and the confidence I have in that company afterwards. So
Yeah.
Disney is one that we had. It's
Yeah.
reinstating the dividend. I'm not going to buy them.
Mhm.
That's one. Tim has asked us, did your consumer behavior change in any way because of the stocks you own? So, for
Oh,
example,
of course. Yeah. 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 So when I'm in the shop and I see that there are two products beside each other and one is from a stock I own, I will buy the stock that I own. The product from the stock that I own. Yeah, definitely. Definitely.
I mean, I'm drinking Smirnoff, which is Diageo based.
Yeah.
Diageo
Yeah.
based.
Yeah. But
I,
yeah,
I,
but there is something to it makes me also proud. Yeah. I mean, they say you shouldn't fall in love with your stocks and such, but sometimes you do.
it's hard not to be biased, isn't it? I don't honestly. I don't think my consumer habits have changed. I am a tight person, so if I see something cheaper, I will probably buy the cheaper one if it's the same
Yeah.
quality. If it's the same quality.
Yeah. But for instance, if I have an opportunity to how is it? Go to the gas station of BP or Shell, and they are like opposite each other, and I need to go at the same time. I will always go to Shell. Always.
I, I would still go to the one who's cheaper. Always.
Yeah, even if it's just a penny.
Yeah, of course. Hey,
Yeah.
every penny counts.
Yeah,
Um,
yeah, yeah. No, no. I have this. I have this.
yeah.
Yeah.
We got a question about NN Group. Is it a dividend trap?
Well, we only will know that in afterwards, right? But I think not.
Yeah. Dennis has asked us, what would you recommend? Buying dividend stocks at market value to own the stock and take advantage of the dividends over time, or setting a lower buying price with a chance it won't get that low and missing out on dividends? How long would you wait? So I, I'm quite impatient with that. Sometimes I try and set it at a lower price, and I think a phrase that you use is penny wise, pound foolish. It
Mhm.
depends on how low you're going. Like for example, I give you Blackstone. For example, they're trading at around $90 now. I won't buy them unless they drop to in around 70 to 75, in around that range. If they get to 75, I'm not going to say I'm going to wait for them to drop to 74 or 73,
Yeah.
72. But there's a significant difference in price that it's worth it for me to wait at this present moment
Mhm.
in time. Someone like Johnson Johnson, who are probably in around fair value, I don't see the sense in waiting and buying them. I don't see myself putting in an order for $140 for them when they're trading in around fair value. I'd rather buy them at the market price.
Yeah. Yeah, 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 because otherwise you're also a bit timing the market, right?
Yeah,
Here.
yeah. So it does come down to your fair value, I think, doesn't it?
Yeah,
What your value of the company is, and for me, I don't want to buy Blackstone at $90. I want to buy them at
yeah.
70. Whereas I think Johnson Johnson or even Texas Instruments are trading in around fair value, so I'm happy to pay that. So
Yeah, and what's good to know for some fair value is like me, it's like the intrinsic value of the company based on its future cash flows
future, yeah,
discounted to today. But for others, a fair value is just the dividend yield. For other fair value is the dividend discount model, which is a combination of dividend growth, discount rate, and the current dividend yield. So there are different way, and others the fair value is the price to earnings ratio. Yeah. So first of all, it's this to establish which methodology you use. And then for me, why I use fair value in general is because it actually protects me mostly also from, I said, price anchoring. Because otherwise you think like, okay, let's assume the stock of Johnson Johnson fair value is 160. Yeah. Then if I would buy it at 115, like I mentioned before, 100, I wouldn't buy it anymore at 152. But because of using fair value, I feel comfortable averaging up. And this is so difficult for me psychologically wise. And this is how I was able to escape this issue of not averaging up. At the same time, how I said, fair value also ensures that I'm not overpaying for the shares And why is this an issue? Because I need to stick to my plan. My plan is having an average yield of 3.25% at buying with a 6% year-over-year dividend growth. So if I start buying things that are just at the market, really overvalued at a low yield, I will not make my, how is it, retire early plan into reality.
Yeah. Last question comes from Brian. Second last question comes from Brian. He says, last week you mentioned that you only allow your tier one stocks to be 4%. I have more flexible. I'm 5% of my portfolio. But how do you think about your portfolio with regards to industry? When growing your portfolio, are you concerned about it being comprised of too many stocks from one industry?
So actually, I have this also. Yeah, I have information technology, and I believe consumer staples and healthcare as my biggest sectors that I want to have in the future. And I'm saying it top of mind, Brian, but I believe that they are around 20% of future allocation. I think materials and utilities should be for me on the lowest end. So I do have this as well. At the same time, you will see that if you go to my blog, EuropeanDGI.com, and you look at the portfolio allocation strategy article via the menu items, you will be able to find it. You will also see my target allocation for the industries, or for the sectors, actually, not for the industry, but for the sectors.
Yeah. So, but do you take note of the industry? Would you have
Yeah.
this? Yeah.
Yeah. I don't want the sector to be higher. I don't want to have a 40% exposure to a certain sector. No, I don't want to. It's too much for me.
Okay. Yeah. In terms of me, I look at the sector, but not too much at the individual industry within that. Typically, I don't buy the same company in the same industry by default. Not for any
No.
reason, not for
Same
any
here.
rules, but it just so happens that if I'm buying a company in the industry, I look at one and I tend to stick to that. So I
Yeah.
don't have a hard and fast rule around it, but it's not something that I'm overly concerned about either.
Yeah.
And then the last question is from Ingi Moore, who has asked us to take a look at a stock from the Faroe Islands. The stock is called Bakke Frost, which is listed on the Norwegian Stock Exchange. And just a little bit about the company. It is a production of salmon, so from egg to fillet. So they're pretty much into the salmon and fish industry.
Yeah, and actually, honestly, the first thing that turns me off is just the dividend history. They've been cutting their dividend in 2019 as an example. And that is a pity, but it's so nice that we found a company from the Faroe Islands. I think the ticker symbol, maybe for our listeners, is BAKKA, trading on the what is it? The Norwegian Stock Exchange. The current yield is 2.15%, or the forward yield at least. There's a PE ratio of about 18. So from that point of view, you could say, matches screener criteria, maybe not dividend yield. Then, in my particular case, it is trading around the 52-week high of around 687 crowns. So it seems to be doing just generally well. I also believe that salmon in generally is a good industry to be invested in, but that's my personal philosophy. I think more and more people are looking after their health and they want to have fish in their diet for the healthy oils. I just don't think that salmon is the most healthy fish there is, but okay, it doesn't matter. It's not about what the facts are, it's what people believe. And salmon is a fish you see in every shop. Yeah, so I can at least see in my circle, which is of course not representative for the entire Europe, but I can see that people are moving more and more conscious about what meat does to their, cholesterol and these kinds of things, and I see them moving more and more to healthier diets. And I always believe that fish is considered part of a healthy diet. So from that point of view, I see a trend in fish consumption, and therefore the salmon production as well as a growing trend still for decades to come.
Yeah, I mean, it's a $7 billion company in revenue. And you think about it, it's crazy because in 2013, it was only 2.5 billion. So as
Yeah.
you can say, that trend in healthy eating and fish and the perceived health of it is quite strong. It's growing quite quickly. Um, I was similar to you when I first looked at it. I seen revenue growth. I was like, wow, I can't believe it's growing that quickly. But in terms of free cash flow and net income as well, it's a little bit more choppy. And in that sense, the dividend has followed suit as well. They have a decent balance sheet though. They've got good interest coverage, so it looks like maybe a good company from that perspective. But as a dividend growth perspective, it's not a good company. But in terms of total return, you're looking at over the last 10 years, you're looking at 28.84% total return, and 11% return over the last 5 years. So total
Mm.
return, good. Dividend growth, not so good.
Yeah.
But yeah, like it's actually awesome to find a company like this from Faroe Islands. So it's quite a small country, and it's no, it's cool.
Yeah. Nice one. Nice one. I didn't even know that they had like something on a stock exchange. So that's also really nice.
Yeah,
Good.
awesome.
Hey, it brings us to the end of the show of the podcast number 145. Thank you for everyone that stuck to us. I hope that we didn't inspire you too much with alcohol and vodka. I hope also you enjoyed this show, and thank you once again for and asking all these questions. We love answering them. So yeah.
Yeah, thanks to everyone, and remember, you can't borrow conviction. See you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.